Assalamualaikum and salam sejahtera. Welcome to ACC106 lecture series number 9, where this video is to discuss on the topic of financial ratio or financial analysis. Financial ratios or financial analysis is based on the financial statements that you already prepared for the business. So when we prepare the financial statement, objectively, we want to provide information on the financial positions of the business entity. So where are they standing at that point? And also, the financial statement will show the financial performance of the business, because once we prepare the statement of profit or loss, we will show whether the company making profit or loss. And also, the financial statements will explain if there is any changes in the financial positions compared to the last year or any other companies. And this financial statement, when we prepare them, the financial statements informations will enable the users to make economic decisions. For example, the potential shareholders or potential investor will look into the financial statement and can make decision whether they want to invest or not in the business. However, by looking at the financial statement that year, particular year alone, it's meaningful for the for the users to make economic decisions. They need to compare the information or the data in the financial statement itself to make a more meaningful results or more meaningful informations that they can use to make decisions. So it come up with the financial ratios or the financial analysis, where the ratio analysis can be in different types, because there are they have been established a lot of ratios formulas to explain a certain items in the financial statements. So the types of financial ratio analysis can be divided into 5 categories or 5 types, where the ratios can belong to the windows of liquidity, where the ratios are calculated to explain how fast the asset will be liquidated or being turned into cash, so that they can use that cash money to pay their short-term obligation. So liquidity basically want to know whether you can pay short-term obligation or short-term debt. The next types is on profitability side, where profitability will explain is it worthwhile, the profit that you made, the profit that the business made, to compare to what they have been invest or expense. For example, is the gross profit worthwhile according to the price that they set? And the other types of ratio analysis is belong to the windows we call efficiency, where these particular ratios will explain whether the management is efficient or not conducting the management tasks in managing the businesses. Usually we hire managers or executives or somebody else to manage our business. So we want to know whether those people we hired has been taken their responsibility to manage efficiently our business. So these ratios can help you making decisions or making the assumptions whether those managers or executives have done their work properly. Another part is solvency, or the types you call solvency. These particular windows to explain to us whether the business is solvent enough, meaning that they are not in the brink of bankruptcy. They have more asset than the debt, and we can predict the business, how long or how many years in forward or in future that the business can long last or can continue. If they do not take any actions, then they will go bankrupt. So solvency will help them to find the weakness in their financial funding. So they need to take action on it. So if they want the business to continue. Another capital markets types is to these are more for the companies that trading their shares on bursa or on the financial market. So these capital market types of ratios will help the investors or the potential investor making decisions whether to buy the shares or to buy their financial instruments offered by the business. So if it is worthwhile, or it is the return from the expected return from the ratios that we calculated is higher or affordable, then the potential investor or investor will invest in the company. However, for ACC106, we only discuss on the three types, that is the liquidity, profitability, and efficiency. Those two, solvency and capital markets, you will learn in the future if you are taking introduction to financial management, then you will learn those two in other subjects. We will look into the first liquidity ratios, the liquidity types. First of all, we'll look into the current ratio. The name of the ratio we call current ratios, where the formula is the total current asset will be divided with the current liabilities. This objective to calculate the current ratio is actually to measure the capabilities of the companies to generate cash or any other things that in the business can be converted into cash. This ratio is actually measure whether the business is valuable enough or to pay their current debt. The ideal ratio for current ratio is 2:1, means that you should have the two portions of current asset to pay one portion of current liabilities. That's the ideal ratio for businesses. So if you, let's say, when you calculate the current ratios, if the current asset is more than the current liability, for example, the result shows 2.1 to 1. So the explanations of the result is the business has 2 ringgit and 10 cents of current asset to pay, or 1 ringgit of current liabilities. So meaning that the liquidity of the business is strong. However, if the current asset is less than the current liability, for example, the result shows that 0.5 to 1. So 0.5 is representing the current asset and the 1 is representing the current liability. So you will explain the business has only 50 cents of current asset to pay 1 ringgit of its current liability. So you can conclude that the liquidity of the business is weak. The next ratios or in the liquidity ratios is asset test ratio, where it's actually the same of the current ratio, except the total current asset now should be deducted with closing inventory and also the prepaid expenses. Then after you have deducted the closing inventory and prepaid expenses, the net of current asset will be current liabilities. So the objective for asset test ratio is to measure the ability of companies to generate most liquid asset to pay its current debt or the short-term debt. And the inventory, the closing inventory, is deducted because it's quite difficult for you to turn the inventory into cash, because you cannot force your customer to buy your inventory. You just cannot take them into your shops and ask them to buy and force them to buy. It will be difficult if the customer does not want to buy the inventory, so it will not be turned into cash. And also the prepaid expenses, the overpaid to the third party. For example, you overpaid to the Tenaga Nasional Berhad, you cannot go to the counter and ask them the cash that you overpaid. They will say that the money will be set off against the next bill. So you will not get the cash money into the business. So that's why the prepaid expenses must be deducted from the total current asset, because it's not those inventory and prepayments are not liquid enough to be converted into cash. It's not easy enough to convert into cash, those two. So it's not liquid enough to be considered as most liquid asset. The ideal ratio is 1:1, means that you should have one portion of most liquid asset to pay your one portion of current liability. So explanation of the results: if your current asset more than current liability, means that the current asset deduct closing inventory, deduct the prepaid expenses, is more than the current liabilities. So let's say 2:1. So you will say that the business has 2 ringgit most liquid asset. Just now, the current asset ratio, we use current asset, but for asset test ratio must use the word most liquid asset to be 1 liquid current liability. And again, we conclude that the liquidity is strong because the ideal ratio is 1:1, but the result that we have is 2:1, so it's strong for the liquidity. If the current asset is less than the current liability, for example 0.5 to 1, meaning that you have only 50 cents of most liquid asset to pay 1 ringgit of the current liabilities, so definitely is weak because you do not have enough sufficient most liquid asset, the cash, to pay your short-term debt. Okay, in some books using the quick ratio for the term of asset test ratio, and some of the books may use the most liquid ratio. So it depends on which term that they use, but is more or less the same. Now moving on to the profitability ratios. The one of the profitability ratios that you usually calculate is gross profit margin or gross profit ratio. So the formula is gross profit, total gross profit, divided with net sales and multiply with 100. Sometimes you do not have the amount of net sales, you only have sales. So you can use the figure of sales instead of net sales. So objectively, the gross profit margin is to measure whether the profit they made is profitable enough for the business. For the gross profit margin, will be compared to the per ringgit of sales. So is it worthwhile, the sales that they made with the gross profit that they made according to comparing with the sales that they already received. For the explaining the result, let's say you calculate and you have 25% of the gross profit margin. So you will explain every ringgit of sales, every ringgit that the sale business made, you earn 25 cents of gross profit. Or you can say 25 ringgit of gross profit was earned for every 100 ringgit of sales. Do not use both. Just choose one, whether you want to explain every ringgit or you want to explain over the every 100 ringgit of sales. Don't use both, okay? Another profitability ratio is net profit margin, where the net profit divided with the net sales multiply with 100, because we want to explain in terms of percentage. Just now, the upper is gross profit. Now we change it to net profit. So the net profit margin and the gross profit margin, the formula is more or less the same. Okay, the objective for net profit margin is to measure the profitability of the business, meaning that how much is the net profit we earn, business earn, compared to the per ringgit of sales that they made. For the explaining the result, let's say you have 15%. So we will say that every ringgit of sales, the business actually earn 15 cents of net profit. Or you can explain in terms of 100 ringgit of sales, because you can use the 15 ringgit of net profit was earned for every ringgit of sales. So the next ratio is efficiency ratio, where we will discuss on the stock turnover, or we call nowadays is inventory turnover. So the word stock changed into inventory. The formula is using cost of goods sold divided with the average inventory, where the average inventory is calculated using opening inventory add with closing inventory and divided into 2. If you do not have the figure of opening inventory, just use the closing inventory. Okay, then the objective of inventory turnover is to determine how many times the inventory is replaced in a year. So it actually will indicate the ability of the business to sell their products. So if the more times of the inventory is replaced in the years, meaning that they are able to sell more, sell quickly their inventory. So meaning that they have good of selling activities. So the higher figure is actually the better. However, depend on the nature of the business. You cannot compare the ability to sell or the inventory turnover between the perishable goods with the non-perishable goods. For example, you cannot compare the business of inventory turnover of people who sell furniture with businesses who sell um, vegetables, because vegetables need to be replaced every day or every 2 days. However, the furniture may take a longer time. So it depends on the nature of the business. So explanation of the result. For example, you have 4 times. You calculate and you receive the result shows 4 times. So business is actually able to replace the inventory 4 times in a year, meaning that it can be replaced in 3 months times, being replaced for the year. But if the explanations for when you for the final assessment, you only just need to put the business is able to replace the inventory 4 times in a year. It's more than enough for you to explain the result. Let's look into the other efficient ratio is account receivable collection periods. Sometimes the books will only use collection periods or debtors collection periods. It is the same ratio, whereby the formula is total account receivables, or sometimes they use net account receivables, net realizable value of account receivables, but you can use the total account receivables, and divided with the total credit sales. Sometimes the business does not provide you the information of credit sales. You may use the sales figure or the net sales figure. However, it will be more accurate if you use the total credit sales. And do not forget, the formula need to be multiplied with 360 or 365, because that is the number of days business operate in the year. Sometimes the company has lots of public holiday, so they will deduct that days to be not a business days, so it can be multiplied with other numbers of days, but usually we use 360 because we assume the another 5 days is an off day. So objective of the efficiency ratio is to determine whether business is able to collect the debt from the debtors, the customer who delay their payment, because we want to know whether the manager is good enough into giving the facility credit facility to the customer, and they should be able to collect their debt from the customer. So these ratios will show whether the manager efficient enough to collect all the debts. So we will determine the average days to collect the debt. The lesser figure is the better. Normally, we will say less than 30 days, because once it's more than 30 days, is ability of customer to pay is becoming less and less. So ideally, it should be less than 30 days. The explanation of the result, let's say you calculate and you receive 35 days. So the explanation say that in average, the business is able to collect debt from customer within the 35 days. I just say that the ideal is 30 days. So 35 days means that slightly not efficient of the manager managing the credit sales. So reasons for analysis. some books say the objective for the ratio analysis. So we use analysis, or we prepare the ratio analysis is actually to compare business performance with prior years, or we compare with the similar business entities or competitors, or we can also compare with the average index produced by the Bank Negara or any other financial institutions that they might release the industrial average. So when we compare with others, with other years or other companies, or with the index, we could assume or make a conclusions that our business performing well enough or not. The main reason usually the company prepare or calculate the financial ratio is actually to identify any other weakness or identify the strength of the business. For example, just now you calculate the account receivables collections period. It shows that the calculations shows that the business only able to collect debts in 90 days. So you will identify that is the weakness of those who managing the credit facilities or managing the credit sales. They are not efficient enough. So we will know where the weakness is. So you need to overcome that weakness. So you can take an actions whether to fire that credit managers, or you can replace with other employees that more efficient than the current credit manager. Once you identify the strength of the business, which part of the business is strong, so you need to take action to maintain that strength of the business so that you can move forward. And another reasons for analysis is, for example, for the supplier to evaluate the customer ability to pay. So when the customer requests a credit facilities, so the seller usually will evaluate whether the customer is worthwhile to be given the credit facility. We call it as credit worthiness exercise. So you need to calculate the financial ratio is whether the customer is stable enough to pay the short-term debt in the future. For the business itself, usually we calculate the ratio analysis to evaluate the potential our business in the future. Potential investor also can evaluate whether the business have a potential in the future in making profit or not. The fund or the loan provider, such as the bank officer, the credit bank officer, will evaluate the business ability to pay the long-term debt, whether the business is viable enough to pay their long-term debt. If the business apply for a loan, for example, so the credit facility manager will evaluate the business. The business is able to pay the principals and also the interest in the future. However, the ratios has a limitation because ratios is not a standalone evaluator of the performance of the business. You need to have a comparison ratio. But the comparison ratio also have only useful if calculated on the same basis. For example, you need to compare last year. So sometimes the background of the business or the economic situation also will influence the ratio. So you not really can compare the ratio from this year to the last year. And the ratios are based on historical data, not the current one. So if you want to, so it has a weakness. It's not the current one. It's not in now data. Is historical. You may say that you assuming the business is performing well now, but you calculate something that has the last year's or the past years of data. So it's not really accurate. As I mentioned just now, ratios are excluding the economic factors because you cannot compare 2019 performance, business performance with 2020 because we have COVID-19 pandemic in 2020. So lots of businesses are facing troubles or shortcomings in their businesses. So you cannot compare 2020 performance index, performance ratios with 2019 or 2018 because the ratios not include that recession times or not include the economic situations. And also inflation's sudden change of price, sudden change of oil price, sudden change of foreign exchange, trading, and also lots of other economic factors that is excluded from while we calculating the financial ratio. So it's limiting to only the financial data. And also the ratios exclude the human element of the firm. We tend to look into the financial data only, but not the element of the human. For example, you have a loyal employees. You're not making that much profit, but you have lots of loyal employees with a low turnover of employees, for example. It's better actually from the higher turnover of employees, but it will not be come out with the calculating the ratios. And if you want to compare small businesses with the other small businesses, that will be impossible because most of small businesses will not share their data with others. So how can you compare your small businesses with other small businesses? So it's so calculating ratios is useless. Okay, that's all for now. Thank you for watching. I will share the how the exercise or how to extract data to calculate the ratios later.